So we have data given around a company and there are three cases that we are taking. The first is a straightforward case. I am just keeping preference capital out of this to keep things slightly more understandable and simple. Debt ratio is 40%, equity ratio is 60%. So effectively, debt equity you can calculate is 0.66 or whatever. Current yield on the stocks is on bonds is 12%, stock beta is 1.2. Similar data. I have the stock dividend data now. Common stock dividend data that is available. So let's quickly calculate after tax cost of debt. That's straightforward. 12% into 1 minus the marginal tax rate, 8.4%. Cost of equity using CAPM is 10% plus beta into the risk premium, which is 5%. Now we have to find cost of equity using dividend discount model, for which we will need next year dividend. Remember, the formula was D1 by P plus G. So we have been given G here. We have to calculate next year dividend. This is last dividend or current year dividend. Next year dividend will be 2 multiplied by 1.08 because there's an 8% growth. So effectively next year dividend is equals to $2, which is last year's dividend, multiplied by 1 plus 8%. Next year's dividend yield is 2.16 divided by 27, which is 8%. Cost of equity based on dividend discount model is this number, which is next year dividend yield plus the growth, which is again 16%. So effectively, whether I use DDM or CAPM in this question, I get the same answer of 16%. I can now calculate the weighted average cost of capital, which is 40% into 8.4 plus 60% into 16%. 13% is the WACC. Fine. That was case 1. Let's now move to case 2, where we are talking about the bond spread of the country. We are talking about the bond spread of the country, and then we are talking about what is the standard deviation of the country's equity market and bond market. So let's assume we are looking the case of an emerging market now. So far what we were looking for, let's assume, was a developed market. Now we are looking at an emerging market. So we will take the risk premium of the developed market and scale it up by using the bond premium. Now obviously the bond premium that you find, the country risk premium that you look at is, so we will look at bond premium, which is equal to 7% minus 5%. 2% extra is the risk of investing in the bond of this country versus US. But remember, when you are talking about the country risk premium, effectively, you have to scale this by the ratio of the standard deviation of the stock market and the standard deviation of the bond market, and add this number to the equity risk premium of a developed market to get the country risk premium, which is 8.2%. All you need to do now is effectively use this as the risk premium. So cost of equity for this firm in a developed market would, let's say, become risk-free rate plus, and I'm using hypothetical risk-free rate numbers, so don't worry about that. Just to showcase how we calculate this, this is the cost of equity using this method. Fine. So that's how we use this method to find out this particular cost of equity. Let's look at the third method, where we look at the beta of a comparable firm. Let's assume now that this beta is not given to us. This number 1.2 is not available to us. If this number is not available to us, then at this point of time there would be an issue in terms of calculating exactly how do we reach to the cost of equity, correct? In this case, we will start discussing a new way of calculating data. So I can find out comparable firms and I can take their beta. The problem with this is that I'm assuming beta shows the risk, and risk is defined by the leverage of the firm, debt equity of the firm. So effectively, if beta is high, or whatever the beta of this firm is, it assumes that my firm under question also has the same debt equity ratio. The beta that we calculate is called the levered beta or the equity beta. This is calculated from the stock market. We have this for a comparable firm. Now, this beta, which is levered beta, has to first be converted into an asset beta or unlevered beta. You call it asset beta or unlevered beta by using this formula. 1 plus debt by equity of the firm into 1 minus T, because debt you take 1 minus T. You will note that debt by equity will be a number greater than or equal to 0, which means when you calculate beta unlevered, this will always be less than beta levered. What does beta unlevered or beta asset, as it is commonly called in the book, is what does it denote? It denotes the risk of the firm if the firm did not have any debt. So if the comparable firm had zero debt, what would its risk have been? So we find the unlevered beta of that firm first, and then we do an exercise called relevering of this beta using our debt equity. Correct? When we do an example, it will become clearer. So effectively, we are first taking the risk of a comparable firm. We are scaling it down to account for the fact that, let's say, the firm has zero debt. What would the risk have been then? And then we put our debt equity on this to find the new beta of the firm under question. Fine. Let's try and understand this. So we have a particular firm, comparable firm, whose beta is given to us. That's 1.6. What we also have is that debt equity of this comparable firm is 1.5. So remember the formula. The formula for calculating asset beta will be 1.6 divided by 1 plus 1.5 into 1 minus the tax rate. Correct? Tax rate we'll assume to be 30% here as well. So effectively, if we calculate for this, we will get the unlevered beta of the comparable firm. So this is equal to 1.6 divided by 1 plus the debt by equity, which is then multiplied by 1 minus the tax rate, which is given here. So effectively, this is what the number looks like. Let me just add a few brackets. Unlevered beta is 0.78. This means that this firm would have exhibited a market beta of 0.78 if they had zero debt. Now we have scaled it down. The assumption that the market is making is that between two comparable firms, if they have no debt, the risk will be perceived to be similar. Fine. Now we will relever it using our debt equity ratio. So we have been given a debt equity ratio here, which is effectively 40% by 60%. So I can calculate this by this, which is 0.66 or 0.67. That's our debt equity ratio in the question. So I can now relever this beta using this debt equity ratio. How do I relever it? Remember the same formula. We will just take the unlevered thing to the other side. So beta unlevered now multiplied by 1 plus debt by equity into 1 minus T is going to give me beta levered of my firm, which I will then use. Correct? So how do I calculate this? This is effectively going to be equal to unlevered beta multiplied by 1 plus the debt equity, which I will just note down as 0.67, and multiply this by 1 minus the tax rate, close brackets, and let me just put in one more bracket here just to avoid any confusion. 1.15 is the beta of our firm given the debt equity of our firm. Because our firm has a debt equity of 0.67 as against the comparable firm's debt equity, which is 1.5, the beta of our firm is lower, in which case you can calculate the cost of equity using the new beta that we have just calculated. 15.7% would be the cost of equity using the new beta that we have just